Let's start with each of the things you mentioned. On interest rates, our view is that till the nominal rates, 10-year rates hit about 5%, till that point, equity markets are likely to be positively correlated to interest rates, so that is good. Even if you take a very conservative view, our opinion is that the threshold is at 3.7%. So since 10 years right now are at around 3% and under, I think we are in a good spot from an equity market perspective. Moving on to the dollar, and what we find is that dollar absolutely impacts a strengthening dollar, the top line and bottom line of companies. But historically what we found is that in equity markets, the investors seem to overlook the hit on earnings from the dollar and are willing to pay a higher multiple. In other words, the impact on returns is a lot less than the impact of the dollar has on earnings. And the last point on trade situation, clearly our view that that is a broad negative, especially for smaller cap companies in America. And this is contrary to the popular belief that these companies are better protected because of their domestic orientation. The problem is these companies in fact have a higher export and import exposure. Their margins are significantly weaker, and hence they cannot absorb costs. And lastly, they don't have the pricing power. So when you put all that together, the impact on earnings for especially smaller companies in the US can be quite substantial. And I think this is overlooked by markets.
Diane, from an economics perspective, triple threat of rising interest rates, stronger dollar, and tariffs. What does it mean as we are about to get on Friday what is expected to be a blowout GDP report in terms of its impact on slowing that down?
Well, what we're going to see is the U.S. economy has a bit of a cushion, and we can weather the storm for a bit, but the storm is still brewing and the undercurrents are clearly forming, and I think that's the way to think of it. Brexit's kind of the cautionary tale where the threat of tariffs, the threat of pulling out of the EU alone over the course of 2 years is now beginning to show in reduced consumer confidence, higher inflation, slower growth, and reduced investment confidence, and actually people moving off to the continent from the UK. So I think we need to think of these things in longer term.
If the full effects of the president's trade war, if it was implemented, was only as bad as what's actually happened in Brexit, you probably have to say the tactics were worthwhile. I mean, the UK is still growing.
But Brexit's a vote.
We haven't seen
it's not an action yet. We haven't seen the effects yet. We're only seeing the uncertainty effects.
Then you can't say, Diane, then you can't say it's an example to... Well, then you can't use it as an example.
It is, because it's showing the effects of uncertainty in policy, and that's what we have right now. We don't have a lot of tariffs. We have things like a strong dollar, which should be decelerating inflation, but undermining competitiveness for manufacturers, at the same time that tariffs are pushing prices up and undermining competitiveness for anyone who uses steel and uses aluminum, which is as Steve pointed out, the math is pretty simple on that. Number of steel users, and it far outnumbers the number of steel producers, so it hurts more people than it helps. You add what should be slowing down rate hikes, a stronger dollar, is no longer can do that because you're adding tariffs. It works over time. The uncertainty factor is that it undermines investment for 2019. If we were to have a full-out trade war tomorrow, which I don't think we're going to have, then you could see a recession in early 2019, and that would be fairly substantial. If we are going to continue to have this uncertainty, then you have, over time, a corrosive effect that builds up in 2019 with less investment.
Hey there, thanks for checking out CNBC on YouTube. Be sure to subscribe to stay up to date on all of the day's biggest stories. You can also click on any of the videos around me to watch the latest from CNBC. Thanks for watching.